Hello and welcome to Chapter 1. This is the beginning of our course, and we're going to talk about an overview of financial management. So what's to come in this class? We're going to talk about various ways companies are organized and managed, and go deeply into concepts of finance and how companies operate. So, starting off, we're going to go through in this chapter forms of business organization, how companies create value for their investors, stockholder manager conflicts, stockholder debt holder conflicts, and finally, how do we balance the interests of shareholders along with broader society. So, in a company, we have the following organizational hierarchy that controls the firm. Starting with the board of directors, and the board of directors in a publicly traded corporation has the ultimate authority over that corporation. Now, the board appoints the executives, and the chief executive is known as the CEO. So think of the CEO as something like the president of a country. He or she runs the company and has control over all of the employees under them. So the CEO is directly under the board. In some companies, the CEO can also have a seat on the board of directors as well. So oftentimes the CEO may be a member of the board, but they do not have to be. Under the CEO are your other C-level executives in charge of whole sectors of the company, such as the COO in charge of operations, the CFO in charge of finance. And under them are all of the VPs and department heads and regular employees under all of the different divisions. Here are some of the employees under the COO, and here are some under the CFO. So all of the company reports down from the C-level officers to department heads to VPs, all of that, and then all of the people under them. There's many levels of management in most large companies. Now, companies can be organized in multiple ways, but we're going to look at the three main ones here, starting with the easiest, which is known as a proprietorship or a sole proprietorship. If you choose to go into business in a simple sense, you can simply open up a business, and that would be a sole proprietorship. A sole proprietorship is indistinguishable from the person who owns it. It's an extension of yourself. Any money you make from it would go on your personal taxes, and it would simply be any kind of business activities you are doing under your own name. Now, the benefits of them are they're very simple to set up. The downside is you get no legal protection. We're going to go into what that means shortly. But sole proprietorships really have no protections. If you get sued, if you're a small store that's a proprietorship, someone slips and falls, you're being sued personally, not your business, because they're indistinguishable. A simple partnership is a simple partnership is close to a sole proprietorship. It just means there's more than one person, but the same thing still applies. The people or the partners who own the firm are indistinguishable from the firm itself. And then most businesses are some form of a corporation, and a corporation does have benefits in a legal sense. We'll get into that in a little bit, but corporations are businesses where the owners own stock in the company is considered its own entity, and as a consequence, the owners get a lot more legal protections than from something like a simple proprietorship or partnership. Proprietorships, once again, and partnerships, the difference is this is one individual, this is more than one. They're very easy to form. If you choose to go into business, well, now you have a sole proprietorship. You don't have to do anything. There's not really much to do. You may have to get a license or something, depending on what kind of business it is. But there's really no difficulty in setting one up. They're subject to few regulations, unlike things like corporations. And there are no corporate income taxes. The reason being, any money you make from a proprietorship goes on your personal taxes. When you file your taxes at the end of the year, you put that as self-earned income. Disadvantages. It can be very difficult to raise capital because the business is indistinguishable from you. So whatever capital you can raise would probably be whatever money you personally can borrow. And that can be difficult if you're trying to scale up the business. You may not be able to borrow millions of dollars in business loans personally. You have unlimited liability. This is an important one. Meaning, once again, if someone sues you, you are personally liable. They can come after your own assets, your house, your car, your bank accounts. You have technically unlimited liability, and as a consequence, you open yourself up to a lot of legal exposure. And they have limited life since they are indistinguishable from the person or persons who own it. They don't live beyond those people. So that is another thing as well. What do we do generally now? Generally now we use what are known as LLCs or LLPs. These are something that came about more recently, and that is known as a limited liability company or a limited liability partnership. Basically, they give you a lot of the protections of corporations, which we're going to see on the next slide, but they're easier to set up than a true corporation. They give you legal protection, so if you get sued, they're suing the business and not you personally, and things like that. But they're easier to set up than a traditional full-on corporation. So a lot of small businesses now use what are known as limited liability companies or limited liability partnerships, where it's basically a hybrid where it's easier to set up than a full corporation. Once again, that's on the next slide, but going to be better in terms of legal protections and all of that than a proprietorship. What's a corporation? Well, corporations are the following. A corporation is how most companies are set up. Owners of a corporation own stock in the corporation. If you buy and sell stocks, if you own stock in a company, you technically are a very small part owner of that corporation. The advantages of them are quite a bit. Number one, they have unlimited life. Since it's owned by its stockholders, there's no one owner that if they pass away or something happens, the company can't continue. Corporations greatly generally will outlive their founders. Easy transfer of ownership. I own stock in Apple and I don't want it anymore. It's pretty easy to sell. Whereas if I have a sole proprietorship, I can technically sell it, but I have to find someone who wants that exact business and is open to running it and all of the things that come along with it. It's a lot harder to transfer ownership in something like a sole proprietorship or a partnership than it is in a corporation. Limited liability. If you have a corporation and someone slips and falls, they can sue the corporation, but they can't generally sue the owners of the corporation. It's very unlikely that would ever happen. It can happen in certain situations if you take business law classes, extreme negligence or things like that. But it's very, very difficult to find the owners of a corporation to be liable, especially things like publicly traded companies. Stockholders generally are never really liable. You buy stock in Apple and Apple dumped toxic waste somewhere, you're not getting personally sued. Your stock might drop in value, but you're not going to be having to face a lawsuit personally. And corporations generally have a much greater ease of raising capital. Why? Because, once again, the corporation is its own entity. It's not one specific person trying to borrow funds subject to their credit or anything else. Corporations are a lot easier to find investors to borrow money as well. That's all kinds of stuff we're going to get into in later chapters in this course. Some disadvantages. Number one, double taxation. Companies file their own taxes, so corporations file a tax return. Most of them do. There are some called pass-through corporations, but most corporations, traditional ones, file a tax return. But then their owners also have to file their own tax return. So any money you make from that corporation goes on your taxes, and the corporation has to pay taxes on its profits as well. So corporations are double taxed and also cost money to set up. Corporations cost money to set up, in every state varies, but the general procedure is you have to file paperwork with the Secretary of State in your state you've chosen to incorporate. You have to run advertisements in a newspaper that you're setting the corporation up. There's filing fees, all of that. So there is a profound setup cost. And also corporations have to file more reports, more tax returns, all kinds of stuff. They have a lot more paperwork involved than something like a sole proprietorship, which just goes on your personal taxes. So there are a lot more reports, and public corporations have a lot more reports. So one that's traded on a stock market have to file a lot more paperwork and meet a lot more rules and regulations. So there's a lot more administrative costs, and there's also setup costs when you are starting and running a corporation. However, corporations do give you a lot more protections than something like a sole proprietorship. And also, one more point I want to make, A corporation is considered a person in the eyes of the law. A corporation can own property, it can own vehicles, it can have bank accounts. A corporation can do all of those things, whereas a sole proprietorship cannot. Those things would all be in the name of whomever owns the sole proprietorship. Whereas if you start an LLC or a corporation, those generally can register cars, or a building can be registered to it, or intellectual property. So corporations get what is known as legal personhood as well. Corporations, once again, utilize stock, and publicly traded corporations, the ones you think of when you think of the stock exchange, or ones you can buy and sell on E-Trade or Schwab or Robinhood or any of those are publicly traded. And what determines the price of that stock, and what we mean by intrinsic value, or what it should be worth? In equilibrium, in efficient markets, over a time, a stock price should equal its true or intrinsic value. So let's look at some determinants of them right here. So what really determines intrinsic value? Actions of management of that company is very important. How is that company being run? How is the overall economic environment? Tax structure, political climate, does it seem to be favorable or negative towards that company? What are the company's cash flows to its investors? How much money is it generating? How risky is it? And that gets balanced by what are its perceived cash flows to investors and perceived risk. How the company is actually doing and how we think it is can be different. It's not always the same. So the true risk and cash flows, that's our intrinsic value. However, what we perceive it to be is its market price. Anytime you might see a company trading at a price and you go, that company's not worth it. If you really believe that, you're saying that its perceived cash flows and risk are different than its actual ones. So that happens a lot of times. You get companies that are both overvalued or undervalued and all of that. So as a consequence, you can have a stock that's oftentimes trading not at its intrinsic value. And finally, what's market equilibrium? Market equilibrium is where your intrinsic value equals your stock price. That's where your intrinsic value equals your stock price. And when you have market equilibrium, what is going on is the company is trading at what it actually should be trading at. In reality, we say markets are efficient, and over a long amount of time they generally are, but you often do have situations where companies can be trading a lot higher or lower than their worth, and that can make investment opportunities as well. We're going to look at determinants of stock pricing later on in the course and go deeper into this. What are stockholder-manager conflicts? So managers, are the people who run a company, by human nature are generally inclined to act in their own best interests. But their own best interests may not always be the same of the stockholders. A corporation's responsibility is technically to its stockholders. The people who own the company, they're supposed to make money for them, run the company as best as possible for the benefit of its owners. But managers may have their own goals that may not be aligned with the stockholders. The managers might want to get the stock price up for a short spike because maybe they own a lot of stock and they want to make themselves a quick, large profit and cash out at the expense of the company. Managers may have the desire to run the business unscrupulously because in the short term it may make a lot of money, and if they get caught and the business fails, they may not care because the business may have made them a lot of money in the interim. So companies can do various things to try to align managerial behavior with acting in the best interest of stockholders. Compensation packages for managers can be written in a way that guarantees they run the company well. They can be paid mostly in what are known as stock options, meaning they have the right to buy stock generally at a price below market value. So they're going to try to want to run the company well and keep the stock price up because they may get options over a series of time. And if they just do run the company poorly or just for a short amount of time, it may cost them money. They may have compensation packages that if the company doesn't meet a certain amount of money, they may not get bonuses. So if profits go under a certain amount or something like that, they may lose lucrative bonuses or something there. So tying compensation packages to performance is one way to try to keep management in line with helping everyone. If they run the company well, they'll do well. All the shareholders will be well. Shareholders can directly intervene. If shareholders call a vote and get over 50% voting in favor of something, they can fire management, they can fire members of the board of directors, they can force votes on things. So shareholders have power. Generally, individual shareholders don't have very much, but if they organize into a voting block, they can. And they can do things and then they can once again do things like threaten to fire management or affect change. And there's also this. This is something we're going to touch upon later in the class, the threat of corporate takeover. Poorly managed companies become lucrative targets to be what is known as taken over, purchased by another firm, either willingly or hostilely, and we're going to look at those things later on. And then the company ceases to exist, and then if you get taken over, management generally all lose their jobs. The company who buys you doesn't want to keep your old CEO generally, or most of your management, so usually they're going to get immediately fired. So knowing all of this are ways for a company to force themselves to act in the best interest, management to act in the best interest of the shareholders. So by doing that, it is going to try to keep us in line. So let's take a look right here at what are known as stockholder-debt holder conflicts. So stockholders are more likely to prefer riskier projects, and the reason being they receive more of the upside if it succeeds. So if you own stock in a company, you want your stock to go up. So you might be very okay with really risky projects because if they succeed, your stock might double or triple or something like that. But bondholders, people who lent money to the company, bondholders and stockholders have one big difference. Bondholders lend money to a company, they don't own the company, whereas stockholders own a piece of the company. We're going to look deeply into both bondholders and stockholders in the chapters to come, but that's the main difference. So bondholders want to get their loan back at whatever interest was promised, make some money there, and they don't want it to be very risky. They're receiving fixed payments on the money they lent to the company, and they want to make sure they get those payments. So they're interested in limiting risk and making sure their loan is repaid. So bondholders get really concerned about additional debt. When companies start borrowing more money, it's generally very concerning to bondholders because it may mean the company is in distress. So they try to protect themselves by including covenants, which are restrictions into bond agreements that limit the use of additional debt and constrain actions. So part of the bond may say the company can only use this money for a certain project at a certain level of risk. They can't just have free reign of what they do with it. And part of it, if they issue $1 billion worth of bonds, the company may not be able to issue more or only a certain amount more go for a certain period of time. That would be an example of a covenant. So bondholders try to cover themselves and protect excessive risk because stockholders and debt holders have different goals. Stockholders want a company to be aggressive and try to grow and generally take on a lot more, are okay with taking on a lot more risk than bondholders who just simply lent money to a company and want to make sure that they get their loan back. So how do we balance shareholder interest in society? This is another conflict here. Because shareholders, once again, generally want to try to make as much money as possible, grow their investment, but that may not be in line with society. A company may do really well, but they also may be polluting horribly or something like that. So in that case, you may be making your shareholders a lot of money, but obviously society is not going to be very okay with a company doing this. So the primary goal of management is maximizing shareholder wealth, maximizing the stock price over a long period of time. So the value of any asset is the present value of its cash flow stream to owners. And this is something we spend entire chapters on to come when we value assets and cash flows and projects and all of that. So most significant decisions are evaluated in terms of their financial consequences. How are they going to affect the company? How much profit can they make? How risky are they? That's how we generally will value business decisions. And stock prices change over time as conditions change and investors get new information about the company. Stock prices are dynamic. They change all the time. So as new information comes out, positive or negative, the stock price is going to go up or down, fluctuate, and as a consequence, change. So, managers recognize that being socially responsible is not inconsistent with maximizing shareholder value. And what do we mean by this? A company might choose to dump toxic waste into the river next to them and maximize their profits. And in the short term, it probably will raise their stock price more than if they choose to properly recycle everything and do all of the required stuff legally. But what happens when they get caught and get fined billions of dollars by the EPA or might go out of business? So, being socially responsible in the long run is consistent with maximizing value, because if you choose to run your company in a very unethical way or not socially responsible, you use sweatshops to make your sneakers in a third world nation, for instance. It might save you money, but once that gets out, you're going to get boycotted, and rightfully so. People aren't going to want to buy your products, and it's going to crush your bottom line. You dump toxic waste and it gets exposed. No one's going to really want to buy anything from you if it turns out that you're polluting your environment or doing all kinds of shady practices. So while that may make you more money in the short run, in the long run it's going to crush you. So maximizing shareholder value, we mean that by over a long amount of time, not a quick spike in the stock price. We mean over a long period of time, making the company grow, increasing wealth for our shareholders. So to do that, being responsible and running a company in an ethical way is definitely aligned with maximizing your shareholder value. So please keep that in mind as we finish this chapter, and we're going to look once again at a lot of these concepts quite a bit more in the chapters to come. So that's going to take us to the end of chapter number 1.